What's up, everyone? Welcome to More Than Mortgages. I'm Chad Anderson. Zach Jones here in just a second. Today and this week, let's talk about mortgage rates and what the future of 2024 looks like. Just 60 days ago, 75-ish days ago, the feds were going to cut rates. We were going to see drops 6, 7 times over the course of this year. Well, guess what? The first time, they kept them the same in January. Second time's coming up in March. What are they going to do? Less than a 10% chance that they drop the rates. What does that mean for the rest of the year and what plays into that? So let's talk about it. Zach Jones, how are you, buddy?
I'm all right today. Not my favorite topic to talk about because we are going in a little bit of a negative direction, but I think it's realistic. So, yeah, life otherwise pretty good, but looks like the sentiment seems to be that rates will be higher for longer.
Yeah, but we've heard it all, Zach. We've heard crash landing, soft
Yeah.
landing, higher for longer. We're going to cut them 7 times. Just kidding. We're going to cut them 4 times. Actually, we may only cut them 2 times. Did you know 350,000 jobs were added in January? Like we're getting like talking from all these directions. It's crazy right now.
Well, think about too. Remember all this talk about recession. Nobody's saying the R word anymore. But remember when recession was defined as 3/4 of negative GDP growth?
Yeah.
And we hit that, and then they redefined what a recession actually is, changed the definition, and nobody's even talking about it anymore, except kind of, hushed tones and behind closed doors and saying, we've been in a recession for a while now, in spite of this. I mean, how weird is it? We're in a recession and struggling with inflation. It's like upside down and backwards world.
Yep. Recession, people simply aren't spending money, right? Like money's just not really circulating. And in today's world, money is still circulating, but there's some strings to that. And one of them is the jobs and bragging and talking and gloating about the number of jobs and the low unemployment. But what people aren't factoring in is how many second jobs are there? How many part-time jobs are being taken on? Other things people aren't talking about as much or noticing. It's one of those, like, it gets thrown out there, but maybe I'm wrong here, but it's never a main topic. And that's credit card debt. We're blowing through record after record on credit card debt in this country. And people are continuing to stretch and spend, and they're holding on for as long as possible. And I think that's why you're also starting to see a lot more cash out refinances. People are getting to a point, and I want to make this clear as well. This isn't a political show. This is an election year, and this is where the government and the feds and the incumbent and the opponents are all trying to spin things in their own favor and what benefits them most. Okay. It wouldn't matter who's in office and who's running against. The spin is always going to be into their direction as a positive.
Right.
So if you look, we had been saying people were going to trade in their 3% rate to grab all their equity and to go buy a new house that they really, really, really want at a 5% rate. And they were okay at that. But they weren't going to do it with rates at 7 or 8%.
Right.
Well, as long as they've held out, maybe they didn't trade their rate and go sell the home and buy the new one. But we're seeing more and more people who are now, it's 1 in 3 transactions or cash out refis right now, or refinances.
Which is crazy.
It kind of blows your mind, right?
Yeah.
And it's a combination. It tells you how little or few of sales are going on in the purchase world also, because just because that number's high doesn't mean there's millions of transactions taking place. Sometimes it just means there are that many fewer purchases taking place over the last year and a half, and that number. But people are looking at it and going, man, unfortunately, we've stacked up a lot of debt over the last year, and it's just killing us. And we're held hostage to our Chase cards and our Amex and Bank of America and all these things. And they're trading the 3% for the 7% to get that equity to hit reset and start back at zero. So we're seeing a lot of different things. But The whole point of this show is this year, as much as everyone was anticipating a big rally, I think over the first, almost 60 days into the year, the reality is setting in that this actually could be the new normal for even longer than what we had anticipated.
Right. Yeah, it seems like the flavor is starting to shift a little bit as we get weaned off of this overly optimistic, the Fed's going to cut rates 6 or 7 times in 2024, and we're just going to see this beautiful downward trend, and everybody got all excited about it, and we're all really clamoring for some good news. America is so vulnerable. I think about, and not to speak about politics, but because this really is an economic kind of show. It's a mortgage show, but I think about how desperate people were before the 2008 election, and how savvy it was for the Obama campaign to posture themselves on hope, and push that hope and change kind of message. I think we're in the same position now, seeing how we just latched on to that 6 rate cuts in a year. It didn't even seem possible to me when they started talking about it. And so, when they revise those projections down to 4, I say, well, that's a little bit more reasonable. Sure. I mean, I could see that. Maybe they slip a half a point reduction in there among 3 other quarter of a point, and it brings it down, a point and a quarter, a point and a half, something like that. That would be awesome. I mean, reasonable, slow growth. But it seems to me, I don't know, are you queued up for that, for the graphic, Chad?
I'm not. I don't have it. I'm sorry.
So
Zach has it on socials. Zach will share it. Just share it on his socials.
We were passing around a graphic that came out that was really a measure of the Fed's sentiment. So this is where it gets a little bit weird. The Fed is supposed to be doing all of these gestures that they do about monetary policy based on data, but there's so much in the market that is emotional and it's interpretive. I can remember back in the Greenspan days when people would say, oh, Alan got up and he talked today, and when he said this, when he said dovish, he turned his head to the left and he looked into the audience and he caught the eye of so-and-so. And what that really means is that it was more of a hawkish position instead of a dovish position. So we're interpreting that. They're not even going by what the guy says. They're going by body language and how he's holding his mouth and stuff like that. So it really is, there's a lot of interpretation, a lot of reading the tea leaves and watching the crystal ball and all this. And this graphic, and I'll share it on my socials today, basically says that the sentiment with all of the Fed members has gone into a higher for longer strategy by about a 33% increase in recent weeks. And so where virtually no Fed members 3 weeks ago or maybe 50 days ago were talking about higher for longer. They were all optimistic about rate cuts coming very quickly. Now about 33% or a third of them are moving in the direction of, gosh, we're just going to be in a very slow kind of a recovery process. So seems more logical to me, Chad.
And to kind of like talk about some of the headlines that have hit, rates took a big dip quickly. And you could see how pent up the demand was back at the end of the year, because as soon as the Feds came out and said, we think we're going to cut 6 or 7 times in 2024, rates fell immediately. Phones started blowing up. I want to go look at this house. I want to refinance. I want to take cash out. What can I qualify for? All those things started happening immediately. Not a trend that gradually got more and more hectic over a week or 2 or a month. It happened overnight. I took 4 phone calls on New Year's Day before lunch. Okay. These are people who weren't, maybe they were or weren't, probably some of them hungover. you know, or slept
Ready
in
to
or
go.
didn't sleep in. Yeah,
Yeah.
they were pumped. It's like, all right, new year, let's go. I need some of those low rates that you guys are talking about right now. That's how crazy it got that fast. Okay. Now, the problem is that we get into the new year, and the bad thing, or the thing that would counteract Fed cuts, because if the Feds cut rates, that means that inflation is beginning to get under control.
Right.
And so things would start to drop. The Feds can drop their rate. Basically, when the Fed raises rates, they're trying to raise them so that you can't keep buying.
Right.
That's what they're doing. They're making it more expensive to buy or to borrow money, which then causes less money to circulate, which drives the cost of things down. Well, what happened right after that? All of a sudden, this massive jobs report comes out. Almost double expectations, right, Zach? Somewhere in there,
Right.
almost double, just an insane number. Who does that look good for? The White House. What happens, though, to that number? How does it impact? Well, if there's more jobs, there's more money being made. So there's more money to circulate, which means now inflation can't go down.
So any improvement in inflation is counteracted by a whole lot more people with a whole lot more jobs spending a whole lot more money, which is going to drive prices up.
Correct. So you got two things. You got this tug of war going on right here. So
Yeah.
now the feds see that number and they go, wait a minute, pump the brakes. If that many new jobs were created and unemployment is basically still the same, we can't keep dropping as aggressively as we thought we were going to be able to in 2024. So then feds, you got to reel it on back now and pull back on what was unofficially, projected or promised. And now here we are again, where over the last 30, 40 days, rates have now started to go back this way again.
Yeah.
And that's because inflation still doesn't appear to be under control. And the other piece of that, and then throw this extra element that we just talked about, is people are still spending through credit cards.
Yep.
So, Zach, I have a question for you on this. Is the spending habit a COVID problem? Where people sat at home, they got two stimuli, however you say it. I don't know.
Stimmies.
You got two of them, and then and you just clicked an order. Like Amazon has ruined humans. You just click an order and it shows up at your doorstep, right? And it got easy and you had more money and more money was given to you. And now it's like people aren't changing their habits. They're continuing to spend. And now they're just doing it on credit cards.
Yeah. I think it's really interesting that you brought that up because you and I have not talked about this, but it's been one of my perceptions, especially recently, as we see the credit card balances are climbing. There's some data out in the system yesterday about how much consumers are using same as cash deals for very small ticket items, like under $250. So these are the 9-month or 90-day same as cash, 6 months same as cash, 12 months same as cash, for things that people would have just normally just bought. It's low ticket items, relatively low ticket items. And I believe that spending is such a habitual kind of thing. And that COVID thing, man, there's so much. I think the psychologists are going to have a field day with COVID for the rest of eternity, as long as they study psychology, because I really believe that people became in some way more attached to things than they were to people. And we consoled ourselves and we found comfort in the acquisition of stuff and the ability to, deliver. I mean, it all came together at the same time. Amazon can put something on your porch this afternoon that you desired this morning, and you can't even find the time to roll down the road 15 miles to the store to get it. Amazon's going to get it there faster for you. No gas. I mean, there's something that's very, very satisfying in that immediate gratification, because it's even more, all of that credit card spending just seems like it's even more gratifying than, going down and buying something at the store, because it's faster. It just, there's a habituation to spending that even inflation and interest rates and breakfast table fights between husband and wife at home, it's not stopping it. It's that people are just continuing to spend, but there's no money. That's the other piece of it. And one of the hidden things in this whole thing about jobs too, I'm getting a little bit off of that topic, but the largest sector of job growth in 2023 and in the current jobs report is government jobs. And those government jobs are going to be paid by taxpayers. And so they're not even really production jobs. They're jobs that cost everybody money. They take money out of the system.
Yep.
So they may be putting money back in the system, but it's the pinch is really in that middle class taxpayer. And
it is.
Those chickens have not come home to roost, Chad. That's a very, very significant concern.
Yeah, it's something. I don't know how it'll work going forward, but let's finish the show on that and kind of what we see the rest of the year. So this was supposed to be, and Fannie Mae, by the way, just announced they revised their prediction on rates for the rest of 2024, and they're on board.
Zillow. I didn't see that about Fannie, but
they
tell
did.
Tell me what they said.
Higher for longer, kind of the same thing.
Okay.
Like the sentiment is now switching. Because remember, just literally 60, 75 days ago, we were talking about being in the mid to high fives by the end of the year. Some projections were even into the low fives by the end of the year.
Yeah. 4.99 FHA. I remember people talking about that. Oh.
Yeah. And now we're in a spot where we don't know if we're going to crack below 6 by the end of the year. That's kind of more of the thing. So I guess if from a consumer standpoint and talking to home buyers and whatnot, my opinion here, and then you're smarter than me, so you can do the rest of it. My opinion here is the demand is still pent up. And if you're trying to time the market, it's the worst idea you could have. Yeah. Because if you could time markets, you should quit your job, move to New York, and be on Wall Street. That's what you should do if you can truly time markets. We don't know. We have no idea. And if you do know, you're just lucky. Okay. If you figure it out and it works out, odds are you were just lucky. Maybe it was a little bit of an educated guess, but probably some luck or a lot of luck involved in there. So my point is, we saw what the pent-up demand looks like. It was like a preview when you go to a movie theater. You saw the 30-second preview that showed what it looks like when rates do tick down just barely. Warren Buffett said it, be greedy when others aren't, and be skeptical when others aren't. Be the opposite, basically, of what the public is doing. If everybody's hoarding, that's a chance, and fearful, that's a chance for you to be aggressive. If they're greedy and aggressive, it's a chance for you to maybe pull back and sell some of your stuff and hold on and take your cash and sit and wait for the next opportunity. But to me, that preview we got at the end of the year and the first part of January is what will happen when these things go down. And they will go down. It has to go down. And so I still say it's a time to, if you can afford it, you should still be looking at purchasing or refinancing if that helps you reset your budget and whatnot, because when these things turn, it will take off. There are too many people still sitting on the sidelines wanting a downturn so that they can jump in and be a part of the competition.
Yeah, and maybe that message is adapted a little bit, because if you're waiting, the wait just got longer, and I keep going back to these indexes, Chad, from last year, in one of the slowest years in recent history, where we still saw home value appreciation close to 7% and that's an average of the indexes. So these are the intrinsic value of homes going up at that's a higher than normal rate. And it's driven by the inventory problem. So in an odd twist, we've got a really low volume moving through the system, or maybe not historically low volume, but much lower than what we've been used to in terms of purchases. Prices are tough, interest rates are tough, and yet the value of the product that's selling continues to go up. And it goes up, at 6%. It's very, very, very hard to make any sense out of waiting whatsoever at these price points. And I did a YouTube yesterday on
that was a good one,
on mortgage insurance, and I dug into the cost of waiting about making a 20% down payment versus buying with a 3.5% or a 5% down payment, and you just can't make any sense out of waiting. Even if you're paying a high mortgage insurance rate because you can't save 20%, it still doesn't make any sense because prices appreciating at 5 or 6 or 7%. And I did my example on 6, which was less than market. It just punishes you, and you can't catch up with
it. Speaking of impatient
visitors.
We get some more cameos here. That's what we get.
So bad news overall, kind of with this higher for longer, but we try to take a balanced perspective on stuff, Chad, and I think that we're reasonable in what our expectations are. While we obviously have biases toward real estate because of the industry that we're in, I think it's important to kind of measure these things out and try to look at them realistically, not pessimistically, not overly optimistic.
Yeah, I think if you just step back and look, I think it's one of those things where, hey, real estate goes up over time, and it's obvious that things are as low as we've seen them in the last 4 years. And they're still going up though, Zach. Like they're as low as we've seen, and they're still increasing on an average. So it's also just from another topic or vantage point. Think about this. You're handed an asset worth hundreds of thousands of dollars, and the bank gives you 95% of the money. Like, that's crazy, right? Or 96.5% of the money.
Yeah.
Like, where can you go get? It's kind of like PMI, because I always talk about PMI is the cheapest money on the market, and people don't realize that. Like, it's literally the lowest APR on the market. And if you look at the same thing with real estate, like, where can you go buy any asset in this country, and somebody else will say, hey, you get in for 3% skin, and I'll get in for 97% skin, but you'll own it. And you'll get
you get to make 7% on the total value for your 3.5%. That's like doubling your money, dude.
I know.
It's year, right?
It's insane. It's insane. So anyway, that'll do it for us. Yeah, like we said, not the most positive news in the world as far as the rates themselves are concerned. But at the same time, they're not going up as of now. And I don't think they will, but they're not going up 8, 9, 10, anything, it's not the 1970s or anything like that. But as far as like them dropping back down, for now, that's not looking as hopeful as we once anticipated. Although I will say, small prediction, the closer we get to the election, look out for it, because you'll have the summer, you'll have activity, you'll have Jerome Powell wanting to keep his job under the Biden administration, and Powell will be pulling for Biden because Trump wanted to fire Powell last go round. And then the White House is going to want some good news and money in your pocket as well right before you go to the polls. So, like I said, I still think you'll see some relief, but the thing is that before that, they could keep climbing, and then when they drop, they only drop back to where they were in March or February or whatever the case may be. So it may not be an overall drop, but you may experience a little relief later on in the year. So keep an eye on that. But anyway, what you can do for us though, while you're waiting on rates is you can hit like, you can hit subscribe, you can hit the bell, you can follow him at Zach Jones Loans, you can follow me at This Chad Is Real. You can DM or comment, collaborate, hang out, chat, whatever. We love to hear from you. And appreciate everybody who has been watching and has commented on this. And we'll talk to you again next week. Take care.
Thanks for joining.